Hello and welcome to another session of the My Solo 401k Financial Weekly YouTube webinar. We're just verifying the audio and we'll get started shortly. Thank you so much for joining. There's the audio. Awesome. If you're on YouTube, please feel free to chat over questions or topics as we'll be going through those topics once we get through the slides that we wanted to share. Please also like and subscribe if you're on YouTube, and then you'll get notifications as we post videos, daily videos. We have these regular YouTube sessions, so you can also get notifications and get access to the recordings. If you have to leave, you can just save this link. You can come back and watch the recording later. Of course, if you're watching a recording, please feel free to post comments. You can also, of course, please like and subscribe. I'll also share with you that we have a wealth of other resources out there. For example, we have a community site, mysolo401k.net/mycommunity, where we host daily Zoom calls at 1 p.m. Pacific, 4 p.m. Eastern, so this time every day. We also have forums where you can post questions 24/7 in the forums. So it's a great way to learn and to share the knowledge. So let me chat over a link to the Zoom, to the community. Okay, so let's jump into it. So today's session is a great session. It's a very popular topic, which is the ability to make mega backdoor Roth contributions. It's one of the top reasons that clients set up accounts with us. So we want to have a deep dive discussion about the A to Z of making solo 401k contributions for 2022, as well as 2023, specifically focused on those clients that are looking to use our plan to make mega backdoor Roth contributions. And moreover, focused on clients that are whose business is taxed as a partnership, a multi-member LLC, someone who's filing a 1065, they receive a K-1 from their partnership tax return. So yes, exactly. Someone who's got a K-1. So the presentation is being provided for educational purposes only. It should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So as far as the agenda, we're going to be discussing the contribution limits, right, for 2022, for 2023. We're going to include the Secure Act 2.0 update. We're going to go through all the rules, right, the different limits for the different types of contributions. And then we're going to use scenarios and examples to really illustrate how that works. We're going to talk about the deadlines, how to make contributions, how to report contributions. So we really want to cover the topic A to Z, all the mechanics. So what are the benefits of a mega backdoor Roth solo 401k? It would be really it allows someone to contribute a relatively much higher amount to a Roth solo 401k. So for example, with our mega backdoor Roth solo 401k plan, one may be able to contribute up to $61,000 or even $67,500 if you're 50 or older for 2022. And then for 2023, as much as $67,000 or even $73,500 if you're 50 or older. And of course, like any Roth account, the benefit of a Roth is you have the potential for tax-free growth. So the money is deposited on a post-tax basis, but the gains are tax-free if one is able to take a qualified Roth distribution. So the first thing to do if you want to make a mega backdoor Roth solo 401k contribution is find a solo 401k provider like us that allows you to make those types of contributions. Of course, you also have to be eligible to set up a solo 401k, meaning you're self-employed with no full-time W-2 employees. So when looking for a solo 401k provider, you're going to want to look for one that offers a plan that allows for voluntary after-tax contributions, as well as in-service either transfer to the Roth Solo 401k or transfer out of the Solo 401k to a Roth IRA, which of course our plan does allow for both. You also want to look for a provider that, like us, that will assist with all the mechanics, right? Because you need to have different sub accounts, right? Pre-tax, Roth, and voluntary after-tax to keep the different types of money separate and segregated so you comply with the pro rata rules. And then making a mega backdoor Roth contribution is going to require that a 1099-R is issued. So you want to look for a provider like us that provides that ongoing compliance support. For example, we handle preparation and submission of the 1099-R as part of our service for no additional charge. So when anyone's thinking about making contributions, right, of course, the question is going to become, okay, how much can I contribute? So there's a number of factors that go into the answer to that question, right? The contribution limits are based on your self-employment income, your age, whether you participate in another plan like a day job plan, the type of contribution that you're looking to make, right? Whether that's employee versus employer, pre-tax, Roth, or voluntary after-tax. And you'll see as we go through the slides, you know, that there's different limits that apply to the different types of contributions. So the first factor on our list was your self-employment income. So your self-employment income depends on how your business is taxed. Like we talked about at the outset, here we're trying to focus on businesses that are taxed as a partnership. So if your business is taxed as a partnership, your ability to make solo 401k contributions is based on your self-employment compensation, specifically line 14 of the K-1, after reducing by 1/2 of the self-employment tax. And it's always important to remember that your ability to contribute to the solo 401k is based off of your self-employment income, your earned self-employment income. So that means that you don't consider W-2 wages from other sources like a day job, right? Because that's not going to be self-employment income. You also don't consider investment income, right? You as the owner of the business, you might be receiving earned self-employment income, but you also might be receiving some type of investment income, or it could be investment income from another source. That also would not be eligible to justify contributions to a solo 401k. So it's got to be based off of that earned self-employment income. So the first things first for a business that's taxed as a partnership is to calculate self-employment compensation. Again, you use line 14, specifically code A of the K-1 that you receive as a member of the partnership, less 1/2 of the self-employment tax. Our solo 401k calculator on our website, mysolo401k.net, will run that calculation for you. We're also helping clients every day, educating them on the rules and helping them run that calculation. Then, of course, you have to consider what year you're looking to make contributions for. So for 2022, the overall limit is $61,000 or an additional $6,500 if you're 50 or older. For 2023, the limits were raised. And they went up to $66,000 plus an additional $7,500 if you're age 50 or older as that catch-up contribution. That relatively big jump in the limits, of course, is a consequence of inflation, right? Because it's a function of the consumer price index. So with inflation going up, the 401k contribution limits also go up accordingly. Then, of course, you have to consider, okay, well, what type of contribution do you want to make? In the words of the IRS, when you're self-employed, you can make both employee as well as employer contributions, because when you're self-employed, you're both the employee and the employer. In terms of employee contributions, those may be made as pre-tax, Roth, or after-tax, or a combination of all three. So Roth and pre-tax contributions, as you'll see as we go through the limits, those are impacted by contributions made to another plan, like a day job plan. Whereas your ability to make voluntary after-tax contributions to the plan is not impacted by daytime job 401k plan contributions. Employer contributions, those are not impacted by contributions made to a plan sponsored by an unrelated employer, like a daytime employer plan. Employer contributions historically have always been made as pre-tax contributions to reduce your taxable income. Now with Secure Act 2.0, those may be applied as Roth contributions. We are going to discuss in a few slides from now that for a plan like ours that allows for making Mega Backdoor Roth Solo 401k contributions, there's no substantive advantage of making those employer contributions as Roth contributions, but we do acknowledge that under Secure Act 2.0, that is now allowable to make those as Roth contributions. And we'll dig into why there is no substantive advantage. So going to the bottom half of the slide, Roth contributions, again, those could be made as employee, technically could be made as employer. So if you're making a Roth contribution as an employee contribution, you can include, therefore, the catch-up contribution. So that's the $6,500 if you're 50 or older for 2022, or the $7,500 if you're 50 or older now in 2023. That really is a type of employee contribution. So if you have the income to justify it and you are 50 or older, you can make that catch-up contribution as a Roth contribution. And so to finish the slide on the bottom right, voluntary after-tax contributions. This is really, with the focus now of Mega Backdoor Roth, this is really how one makes a Mega Backdoor Roth contribution, because you're making that contribution as a voluntary after-tax. So a voluntary after-tax contribution is really a type of employee contribution. So we'll see why that's relevant when we talk about reporting contributions, for example. It does not include the catch-up though, right? It's technically a different limit under the rules. It's the 415C limit. So when we look at the voluntary after-tax contribution limit, we'll see how it does not include the catch-up, and then we'll illustrate it with examples to really hammer it home. Even though it's an employee contribution, because it comes from the 415C limit, it's not impacted by contributions made to a plan sponsored by an unrelated employer. So even if you max out to your day job, you're not going to reduce how much you can contribute to the solo 401k as a voluntary after-tax. So again, we'll go through examples to really illustrate that and how that works. But that's a good introduction to these different types of contributions. So now let's go through them again, but really break it down. So first, we'll start with pre-tax employee contributions. So employee contributions, they're also referred to as salary deferrals. The limit is 100% of your self-employment compensation, dollar for dollar, up to $20,500 for 2022, plus an additional $6,500 if you're 50 or older. For 2023, it's 100% of your self-employment compensation up to $22,500, plus an additional $7,500 if you're 50 or older. Now remember, self-employment compensation for a self-employed business taxed as a partnership is a product of that pre-calculation of line 14 of your K-1 less 1/2 of the self-employment tax. So once you've done that calculation, assuming you've got at least, for example, $20,500 for 2022, and you set up the plan before December 31st of 2022, you could contribute 100% of that self-employment compensation, dollar for dollar, as an employee contribution to the solo 401k. Now, we talked about this, but just to emphasize it, you do need to reduce by any contributions made to another plan, like the day job plan, because that employee limit applies at the employee level. So if the employee already maxed out the employee contributions to the day job plan, they're not going to be able to make any more contributions to the solo 401k. Now, the one exception to that rule is if the other plan is a 458 governmental plan. In that case, the contributions are not aggregated. So those employee contributions could be made as pre-tax. Those employee contributions could be made as Roth. You could do 100% pre-tax 100% Roth, or some type of mixture of the two. If those contributions are made as Roth contributions, they need to be deposited into a separate sub-account for each participant. So now let's talk about the employer contributions. So the employer contributions are also referred to as profit-sharing contributions. The limit is 20% of your self-employment compensation for a self-employed business that's taxed as a partnership, right, where a 1065 is filed for the self-employed business and a K-1 is issued to the partners. So remember, self-employment compensation is line 14 of the K-1 less 1/2 of the self-employment tax. So I think we're back. Sorry about that. Let's get the screen back up. Please verify you can still hear me. We'll do some testing on our end too. One second, let me get caught up back to our where we left off. Appreciate your patience. You can. Okay, thank you so much for verifying. Technical difficulties. So let's get back to where we were. So I believe we left off here talking about the employer limit, right? It's 20% of your self-employment compensation. So now you have to keep in mind the overall limit. So the sum of all contributions made to the plan, if it's employee, employer, voluntary after tax, cannot exceed the overall limit, right? 61,000 for 2022, or 67,000 if you're 67,500 if you're 50 or older, 66,000 for 2023, or 73,500 if you're 50 or older. Unlike the employee contributions, which are impacted by contributions made to another retirement plan, like the day job plan, the employer limit applies at the employer level. So you don't have to reduce how much is made to another plan. That how much you make to another plan doesn't reduce your ability to make contributions to the solo 401k. Now, the one exception to that rule is if contributions are made to a 403b plan. So in that case, you do have to consider those contributions made to a 403b plan, right? If they could be made by you or on your behalf, in which case those 403b contributions do reduce how much you can contribute to the solo 401k. So now let's talk about the Secure Act 2.0 update, right? So with the Secure Act 2.0 being enacted, effective immediately, employee contributions may be made as Roth contributions. But as I mentioned before, for a solo 401k plan that allows for mega backdoor Roth contributions like our plan, this change really offers no substantive advantage. So why is that? So number one, with making contributions as voluntary after-tax contributions, one is going to be able to, with less income, be able to get to the limit, right? So you're going to be able to get to the limit faster. And that's because when you're making voluntary after-tax contributions, you're able to contribute 100% of the self-employment compensation dollar for dollar as a voluntary after-tax contribution, which can then be transferred over either to the Roth Solo 401k or the Roth IRA. Whereas, as we just saw in the prior slide, the employer contribution limit is 20% of the self-employment compensation for a self-employed business taxed as a partnership. From a deadline perspective, the deadlines are the same. So even if someone is here in 2023, they're looking to make 2022 contributions, they didn't set up the plan by the end of December 31st, 2022. But if they set up the plan in time to be able to make contributions by their 2022 business tax return deadline, including any timely filed extension in 2023, they're still going to be able to make both the employer as well as the after-tax contributions. They cannot make the employee contributions if they didn't set up the plan by the end of last year, but they could still make both types of contributions. So from a deadline perspective, those two contribution types are the same. Lastly, voluntary after-tax contributions are more flexible because voluntary after-tax contributions, they may be transferred out to a Roth IRA. Whereas if you're making employer contributions, even if you're making them as Roth contributions, one would have to meet a triggering event, such as being at least 59 and a half years of age before the Roth contributions could be transferred out to a Roth IRA. So for all those reasons, again, making employer contributions as Roth contributions offers no substantive advantage over just simply making those contributions as Mega Backdoor Roth contributions. Okay, so now let's talk about some FAQs. Do I need to deposit employer solo 401k contributions made as Roth solo 401k contributions in a separate account? The answer is no. Both employee and employer contributions that are made as Roth contributions can be deposited into the same Roth Solo 401k subaccount. What is the contribution limit for employer Solo 401k contributions made as Roth Solo 401k contributions? What's the 20% of self-employment compensation limit that we just went through? How do I report employer Solo 401k contributions made as Roth Solo 401k contributions on my business or personal tax return? Well, that's a great question, and there's no specific IRS guidance yet on how to report those employer non-elective contributions made as Roth contributions. And of course, it would not be prudent to report those contributions as deductible expenses because those contributions are made on a Roth post-tax basis. So there's no guidance yet. Whereas, of course, we know exactly how after-tax contributions are reported. So now let's go through the after-tax contribution limit. So the ability to make after-tax contributions is really how one makes Mega Backdoor Roth contributions, because as you'll see on this slide, the voluntary after-tax contribution limit is much higher than the Roth Solo 401k contribution limit. Again, the Roth Solo 401k contribution limit is that employee limit, $20,500 for 2022, $22,500 for 2023, plus the catch-up if you're 50 or older. With the voluntary after-tax contribution limit, the limit is the lesser of your self-employment compensation. Remember, that's line 14 of the K-1, less 1/2 of the self-employment tax, dollar for dollar up to the overall limit, right? $61,000 for 2022, $66,000 for 2023. So it's the lesser of the two, but you can go 100% dollar for dollar up to that limit. Now, of course, you do have to consider the overall limit. So you have to reduce how much you can contribute as a voluntary after-tax contribution by any employee or employer contributions made to the solo 401k. Now, what's interesting is that you don't have to reduce how much you made as a catch-up contribution. So you ignore catch-up contributions when you're reducing how much you can contribute as an after-tax, but the limit doesn't go up. So effectively, you get to the same place, but you make that catch-up contribution not as an after-tax contribution, you make it as a employee contribution, whether it's a pre-tax or Roth employee contribution. So even though after-tax contributions are employee contributions, because they are part of the 415C limit, they're not impacted by contributions that are made to another plan, like a day job plan, unless the other plan is a 403B. And then lastly, just like with making Roth contributions, how they have to be deposited into a separate Roth Solo 401k sub account, voluntary after-tax contributions likewise need to be deposited into a separate sub account for voluntary after-tax solo 401k funds, which is how one ends up with 3 accounts, right? You might have pre-tax, Roth, and after-tax, or maybe 6 accounts. If there's 2 people participating in the plan, like a husband and wife that are both working in the same business, each might have their own pre-tax, Roth, and after-tax for a total of 6. So now let's go through scenarios. So we'll start with the base scenario, define the base, then we'll change it to see how that impacts how much one can contribute to really illustrate different rules. So with our base scenario, we're talking about a self-employed business, tax as a partnership, multi-member LLC, tax as a partnership. Start out with a 1 participant scenario who's under 50 years of age, does not make contributions to another plan. Their goal is to first maximize the pre-tax, and then if they're able to, make additional contributions as either Roth or after tax. We'll assume that they have $100,000 of self-employment compensation. Remember, self-employment compensation is line 14 of their K-1, less 1/2 of the self-employment tax. And then lastly, we'll assume that all those employer contributions are made as pre-tax contributions because there's really no substantive advantage of making those employer contributions as Roth contributions for a plan like ours that allows for Mega Backdoor Roth Solo 401k contributions. So in the base, this person is going to first make their pre-tax contribution, make their employee contribution as a pre-tax contribution because their goal is to first maximize pre-tax. So they're going to be able to contribute 100% of their self-employment compensation, dollar for dollar, up to $20,500 for 2022 or $22,500 for 2023. They're going to then go on to make an employer pre-tax contribution equal to 20% of their self-employment compensation or $20,000. And then they'll make the difference as a voluntary after-tax contribution. So remember that the voluntary after-tax limit is 100% of the self-employment compensation, dollar for dollar, up to the overall limit, but reduced by any other employee or employer. So for 2022, they made $100,000. They can go all the way up to 61, but then reduce it by 20,500 employee, 20,000 employer, leaving 20,500 that could be contributed as an after-tax contribution for 2022. For 2023, they're going to be able to contribute 23,500 as an after-tax contribution. So now let's change the base scenario. Instead of $100,000, let's assume $50,000 is self-employment compensation. Remember, again, that's line 14 of the K-1, less 1/2 of the self-employment tax. So here, this person's still going to be able to contribute the same amount as an employee, right? It's 100% up to $20,500 for 2022, $22,500 for 2023. Here, their employer amount goes down, right? Because it's now 20% of 50, which is 10,000. And then they can contribute the difference as an after tax, but all the way up to 50,000, right? Because you can't save more than you earn. Remember, the voluntary after tax limit is 100%. So it's the lesser of the self-employment compensation or the overall limit. Since their self-employment compensation is lower than the overall limit, it would be 50,000 less 20,500 as an employee, 10,000 as an employer for 2022, leaving 19,500 that they could contribute as an after-tax contribution for 2022, and 17,500 that they could contribute as an after-tax contribution for 2023. So now let's go back to the base. It's back to 100,000, but here let's assume that the individual participates in a day job 401k plan and maxes out their contributions to the day job plan. In other words, they contribute $20,500 for 2022 and $22,500 for 2023. So where does that leave them with their solo 401k? So first of all, they're not going to be able to make any employee contributions because that employee contribution limit applies at the employee level, and they've already maxed out their employee contributions to their day job plan. They are going to be able to make employer contributions. That would be the same, right? 20% of $100,000 or $20,000. And then they can just do the difference as an after-tax contribution. So this is a good illustration, remember, of how the voluntary after-tax contribution, as well as the employer contribution limits, are not impacted by contributions made to another plan sponsored by an unrelated employer, like a day job plan. So here, this individual is going to be able to contribute $41,000 for 2022 as a voluntary after-tax contribution, and $46,000 for 2023 as a voluntary after-tax contribution. So now let's go back to the base. Now with this, again, this individual does not make contributions to another plan, but let's assume that they're not interested in making pre-tax contributions. They're only interested in making Roth or after-tax contributions. So how does that impact how much they contribute? So instead of making that employee contribution as a pre-tax contribution, here the individual is only focused on Roth. So they're going to make it just as a Roth contribution, right? So it's the same amount, but instead of depositing it into their pre-tax account, it'll go into their Roth Solo 401k account. They're not going to make any employer pre-tax contributions because they're not interested in making those types of contributions. So now they just make the difference as a voluntary after-tax contribution. So $40,500 for 2022, $43,500 for 2023, and then they can move those voluntary after-tax funds from the voluntary after-tax sub-account to their Roth Solo 401k sub-account. So for 2022, they'll end up with $66,000 in their Roth Solo 401k sub-account. For 2023, they'll end up with $66,000 in their Roth Solo 401k sub-account. So now let's go back to the base, but let's assume that we've got two participants. Let's presume that each person has $100,000 of self-employment compensation. So each person has their own K-1, and after reducing that line 14 of the K-1 by 1/2 of the self-employment tax, they have $100,000 each of self-employment compensation. So here, the amounts that are being contributed are the same, but what this shows is that each person is now able to contribute these amounts, right? So each person is going to end up with $61,000 in their solo 401k for 2022 and $66,000 in their solo 401k for 2023 each. So now let's go back to the base, same as the original assumptions, except for now let's assume the individual is 50 or older. So what changes? So what changes is that they're able to make the catch-up contribution. So for 2022, that's $6,500. For 2023, that's $7,500. And this is also a good illustration of how that voluntary after-tax contribution limit, the amount is not reduced by how much you made as a catch-up, but it also doesn't go up. So at the end of the day, the person's now, contributing that additional amount. They've got $67,500 that's going into their solo 401k for 2022. They've got $73,500 that's going into their solo 401k for 2023. But that catch-up amount is going in as a pre-tax employee, because here their goal is to first maximize the pre-tax before they turn to the Roth or the after-tax. So now let's go back to the base. We're back to just one participant. They're under 50. They're maxing out contributions to their day job plan. But here they're not interested in pre-tax. They're only interested in making Roth or after-tax. So they already maxed out the contributions to the day job plan. So they're not going to be able to make any employee contributions to the solo 401k plan because that employee limit applies at the employee level. They're not interested in making employer pre-tax contributions. Again, they're only interested in Roth or after-tax. So that means they just make 100% of the contribution as an after-tax contribution, right? After-tax contributions are not impacted by contributions made to another plan like a day job plan. So this individual is going to be able to contribute $61,000 for 2022 as an after tax, $66,000 for 2023 as a voluntary after tax. So let's keep going. So the next slide is a similar scenario, except for this, and this time the individual is 50 or older. So they're still maxing out contributions to their day job plan, but now it's $27,000 for 2022, $30,000 for 2023. They're still only interested in Roth or after tax. So how does that impact how much they can contribute? So again, they're not going to be able to make any employee because they already maxed out at their day job. They're not interested in employer. So it's the same amount, but this shows again that voluntary after tax limit doesn't go up by the catch-up amount. And this person's already made their catch-up to their day job plan, so they're not going to be able to make it to the solo 401k. Okay, so here we're back to having two participants. Each person's maxing out contributions to their day job plan. Each person has $100,000 as self-employment compensation. Each person is only interested in making Roth or after tax. So really the limits don't change. The amounts don't change. This just highlights that each person is able to make these contributions. Okay, great. So now that we've gone through the scenarios and we understand the limits better, let's talk more about the mechanics, right, of actually depositing those contributions. So how do I make contributions? Well, of course, you can make the contributions by writing a check payable to the name of the solo 401k and writing annual contribution on the memo section of the check. Electronic transfer is also acceptable from a solo 401k perspective. You'll, of course, need to check with the financial institution that holds the accounts. We help clients open accounts at hundreds of different banks and many different brokerages. It's noteworthy that most of the brokerages, as a general rule, do not allow for an electronic deposit from an external account that's not in the name of the plan, right? It could be an external account in the name of the business or a personal account. Typically, those brokerages are going to require that electronic deposit come from an account that has the same name. So the one exception to that general rule, though, is Fidelity, which does allow for an electronic deposit from an external account where the name is not in the name of the plan. In other words, the name doesn't match. So that's noteworthy if you're looking to make those types of electronic deposits. Of course, each person is going to deposit his or her contributions into separate sub-accounts. So back to the, say, husband-wife scenario, where they're both working in the self-employed business, they would each have their own separate sub-accounts. And then again, separate sub-accounts if you have pre-tax, Roth, and after-tax. You might end up with 6 accounts if you have that two participant scenario. The contributions from a solo 401k perspective can be made in whichever interval you want, right? It could be one lump sum, could be a series of contributions. The key is more that it's made within the limits and by the deadlines and the separate accounts. From a solo 401k perspective, it's perfectly acceptable for the contributions to be deposited from either a personal account or a business account, regardless of whether we're talking about employee, employer, or voluntary after tax. The deadline to make contributions is the business tax return deadline. This is clear based on IRS publication 560. There's a chart on page 3, which we have a snippet of here, which shows that as long as the plan is set up by the end of the tax year, that'll preserve the right to make all types of contributions until the business tax return deadline, including any timely filed extension. So for a business tax as a partnership, if the plan was set up by December 31st of 2022, that means that one has until March 15th of 2023 or September 15th of 2023 if a timely extension was filed for that 1065. And then if the plan is set up by the end of 2023, then one has until March 15th of 2024, or again, if a timely extension is filed for that partnership tax return, until September 16th of 2024 to make all types of solo 401k contributions to the plan. How do I report contributions? Well, it depends on what type of contribution we're referring to. If it's a pre-tax employee or a pre-tax employer, those contributions are reported on line 16 of Schedule 1 of the 1040, as well as line 13 of your K-1 using code R. If one is talking about Roth employee contributions or voluntary after-tax contributions, those contributions are not reportable. So it's only the pre-tax contributions that are reportable. Now, it's noteworthy that the voluntary after-tax contributions are indirectly reported on the 1099-R. So this, not the contribution itself, but the subsequent transfer from the voluntary after-tax solo 401k account to either the Roth solo 401k account or out of the plan to a Roth IRA. In either case, a 1099-R has to be issued. And that's really getting to the substance of making that mega backdoor Roth contribution. So how do I convert after tax to Roth? Well, from a solo 401k perspective, it could be by check or by electronic transfer. Of course, you'd want to contact the financial institution providing the accounts to determine the electronic procedure. If you're transferring to the Roth solo 401k account, it could go, between a bank and a brokerage. It could go within a brokerage. So we'll go to the next few slides to really illustrate the process, because some of the top places that our clients are opening accounts are brokerages like Schwab, Fidelity, TD Ameritrade, just to name a few. So here we want to go through the steps, and you'll see quickly that there's a pattern that emerges. So the first step, of course, would be to open, and we'll start with Schwab, right? Would be to open a brokerage account at Schwab, which we're helping our clients every day open accounts at the bank or brokerage of their choice. So we would draft the paperwork that Schwab requires to open up a free brokerage account at Schwab. So once that account is opened up, then one can make the voluntary after-tax contribution, of course, within the limits, within the deadlines, all the rules that we just went through, and then convert the money to a Roth account. So one could either convert to a Roth solo 401k, in other words, an in-plan conversion, or convert out of the plan to a Roth IRA. It could be a Roth IRA at Schwab or a Roth IRA at a different institution. In either case, that's going to be a reportable event. Clients use a form on our website to give us the information that we need to put their plan in the queue to prepare that 1099-R. So we've got one form for after-tax to Roth solo 401k, and then a different form for after-tax solo 401k to Roth IRA. If you go to our main website, mysolo401k.net, in the upper right, you can find these forms at the upper right where it says forms. Just click on that link. So Fidelity, that's another very popular option. It's going to be a similar process. Open a brokerage account at Fidelity, specifically for voluntary after-tax funds. Make the contribution, convert to Roth, either Roth solo 401k, like another brokerage account at Fidelity for the Roth solo 401k, or to a Roth IRA. Then let us know about the conversion so we can capture the information that's needed for the 1099-R. Likewise with TD Ameritrade, another very popular place where clients are having us help them open accounts. So again, it's going to be the same process, right? Open TD Ameritrade brokerage account, make the contribution, convert to either a Roth 401k or Roth IRA, then give us the information so that we can put the plan in the queue to prepare the 1099-R. So then a good question that will come up is, okay, should I convert to Roth IRA or Roth solo 401k? And there's not one blanket answer, but there's different important considerations. So one of the popular reasons why clients want to open accounts with us is the ability to invest in alternative investments like real estate, crypto, notes, precious metals, etc. So with our Roth solo 401k plan, if the funds are kept in the Roth solo 401k, you're going to preserve the ability to invest easily with checkbook control in those types of investments. Whereas if one wants to invest a Roth IRA funds into alternative investments, one would need to have a specialty Roth IRA, one of these specialty self-directed IRA providers, or use like our Roth IRA LLC, which we offer, which would give you the checkbook control. But it's not going to be as easy as making that investment via the Roth solo 401k directly. So that would be a reason to keep it in the Roth, right? Also, if you want to preserve the ability to take a solo 401k participant loan, right? You can't take a 401k loan from an IRA, any type of IRA, including a Roth IRA. Whereas, of course, with our Roth solo 401k, you can take a loan. And we prepare the required loan documents as part of our service for no additional charge. Now, reasons why folks might want to transfer the money to a Roth IRA. Number one, there's no RMD that applies to a Roth IRA, right? Roth IRAs are not subject to require minimum distributions, whereas the Roth solo 401k plans are subject to RMDs. Now, it's noteworthy that some clients, once they reach the age where they have to take an RMD, they will transfer their Roth solo 401k funds to a Roth IRA because, of course, at that age, right, they're over 59 and a half, they're eligible to transfer the funds out of the plan to flush it out, to zero out the plan so that no RMD applies at least to their Roth Solo 401k balance, right? Another reason might be just someone might have a specific Roth IRA where they just like they want to just fund that account. They like the investments. And so they're not interested in making alternative investments. It could be a certain mutual fund or something. And so they want to just have the funds go over to the Roth IRA. And either is, a good answer, and you can do both with our plan. Now, it's also noteworthy that there's no deadline to convert those voluntary after-tax funds, right? There's a deadline to make the contribution, but the subsequent transfer from the voluntary after-tax Solo 401k sub-account out to the Roth Solo 401k or Roth IRA, there's no deadline to make that. So you'll have situations where folks might be making voluntary after-tax contributions for 2022 in this year, 2023, right, by their deadline, March 15th or September 15th of this year, if you file a timely extension for your partnership tax return. But that subsequent conversion from, say, the after-tax Solo 401k to the Roth Solo 401k or the after-tax Solo 401k to the Roth IRA, that's reportable on a 1099-R, but for the year of the conversion. So that 1099-R is not going to be issued until 2024 as a 2023 1099-R. Tax reporting, so that is reportable, right? It's reportable on the 1099-R for the year of the conversion. And then on the 1040, right, you put the amount converted on line 5A and any gains, if any, there may not be any, on line 5B of your form 1040. And again, we have forms on our website where clients are giving us the information we need to prepare that 1099-R. So with these last set of slides, before we turn to the good questions, we've got some good illustrations of how the different account setups might look, right? With this one participant scenario, the person has pre-tax, Roth, and after-tax. So you can see they've got 3 different sub-accounts. With the 2 participant scenario, if the individuals are trying to make Mega Backdoor Roth contributions, now you got 6 sub-accounts, right? Pre-tax, Roth, and after-tax for each person. Right, here's a scenario where someone is trying to transfer the money out of the plan to a Roth IRA. So they may just have a pre-tax Solo 401k account for any pre-tax funds, and then an after-tax account for their Solo 401k, and then the funds are transferred out of the plan to a Roth IRA. So that takes us to the end of the slides. Thank you so much. Again, we want to highlight the resources, our community, mysolo401k.net/my community. We have these daily Zoom calls every day, same time, same place, 1 p.m. Pacific, 4 p.m. Eastern. You can also post questions 24/7 in our forums. And then please, of course, like and subscribe on our YouTube channel as we post videos daily. It's a great way to learn and to share the knowledge. So let's go through the questions now. Thank you so much for bringing the good questions. So where in Secure Act 2.0 does it allow for Roth 401k contributions by the employer? Great question. Unfortunately, we don't have chapter and verse in front of us, but it certainly is allowable. But as we talked about in the earlier slides, for a plan like ours that allows for Mega Backdoor Roth contributions, there's really no substantive advantage of making employer contributions as Roth contributions. So thank you so much for bringing the good question. If you don't need to contribute more than 25% of your W-2 income via company profit sharing, does it make sense to contribute directly to the Roth 401k account as opposed to the extra steps of after tax? Great question. And I'm assuming you're talking about making a Roth employer contribution. And I would say you would still have, let's go back to the considerations here. Sorry for going through the slides. Here we go. So quick. So as we talked about, right, one can more quickly get to their contribution goals by making an after-tax contribution because you're able to contribute 100% dollar for dollar. Whereas with making contribution as an employer contributions is a percentage, right? So for a sole proprietorship, a partnership, it's the 20% of self-employment compensation. For a business, it's taxed as an S corp. It's 25% of the W-2 wages. That's the employer contribution limit. And whether those employer contributions are made as Roth or pre-tax, it's the same limit. But your point is, okay, well, I'm not looking to make more than 25% of my W-2. So we would still point out, though, that it's not clear, like the IRS hasn't published guidance yet on how to report those employer contributions. So that would be another reason I would say that folks would say there's no advantage of doing it as an employer Roth, non-elective, as a Roth. So let's go with the proven path. The plan allows for it, like ours does. You also now, by making the after-tax contribution, you also have that ability to transfer out to a Roth IRA, whereas you don't if you're making those employer contributions as Roth contributions. So that would be additional considerations. Hopefully that helps. Thank you so much for bringing the good question. I have solo 401k accounts for self-employment income. I'm considering setting up an S corp for my self-employment income. Will I have to create new accounts for the solo 401k? So it sounds like you have a solo 401k plan through a different provider, maybe like a basic solo 401k plan through a brokerage, which is very common. We have a lot of folks that start out with a basic plan and then they want to upgrade their plan to take advantage of the service and features we offer, like the ability to have Mega Backdoor, solo 401k participant loans, the service, right? We prepared the 5500 EZ, the 1099R. So in that type of scenario, the plan is going to continue, but it's going to be restated under our plan documents. But as part of that restatement, new accounts will need to be set up because the existing accounts are associated with that existing set of plan documents, which doesn't allow for the Mega Backdoor or the other features that you may want. So a new set of accounts would need to be set up associated with the restated plan documents, and then the cash and assets be transferred over to the new accounts. And we guide our clients through that process, right? Preparing the transfer paperwork, preparing the paperwork to open up the new accounts, et cetera, et cetera. Hopefully that helps. And we think we got to this one during the discussion. Thank you so much for the good question. If your group opens a retirement trust, can I select to include my wife in the trust, even though she currently does not work in my company, but may in the future? I would open sub-accounts when needed. Great question. Absolutely. She can be added as a co-trustee. No requirement to work in the business, no requirement to own part of the business. Now, in order for a spouse to be able to participate in the solo 401k plan, the spouse does need to be working in the business and reporting the spouse's own self-employment compensation, like a separate W-2 for the spouse for a business tax as an S corp, or a separate Schedule C for a business that's taxed, say, as a disregarded LLC, or a separate K-1, right, for a business tax as a partnership. And then at that point, because the spouse is already listed as a co-trustee, right, it's going to be very easy to onboard the spouse. It would just be a matter of opening up accounts for the spouse, which we would help with as part of our service. Hopefully that helps. Thank you so much for all the great participation. Please, again, like and subscribe to our YouTube. If you're watching on a recording, please don't hesitate to chat over questions. Please engage on our community. We go, again, mysolo401k.net/my-community. I actually have accounts through your firm, but I'm changing from, thank you so much, we appreciate it, from sole prop to S. Do I need to create new accounts? No, you do not. A change like that does not require changing the accounts or the investments. So there's no need to change the accounts. Good question. All right, we'll give it another minute. Again, in case there's any final questions. Thank you again so much for all the good participation. Please continue to track and stay in touch as we post these educational videos all the time, whether these webinars or our daily videos. So I could open trust checking account at my bank, then link them to the associated brokerage accounts properly designated, so I can have checkbook assets, but also a broker. So that is correct. You could definitely have both bank accounts and brokerage accounts for the solo 401k, and we help our clients open up those bank accounts. Now, what's interesting is that a lot of the brokerage firms, such as Fidelity, Schwab, just to name a couple, they actually offer free checkbook access with the type of accounts that we're setting up. You can also wire money out of the accounts. But for folks that want to invest in alternative investments like real estate, etc., a lot of those individuals do find that it's helpful to have a bank account, because now you get access to things like certified bank checks, debit cards, the ability to ACH money easily in and out of the account. And again, we help our clients open up bank accounts. We've got clients that have accounts at hundreds of different banks, many different brokerages. As far as setting up a bank account to make contributions, you could do that, or you could transfer the money to a non-retirement brokerage account at the brokerage and then just move it from the non-retirement brokerage account to the applicable brokerage account for the solo 401k. So hopefully that helps. Good question. All right, looks like that takes us to the end. Thank you so much. Take care, everyone. Awesome. Thank you. Take care.